Are you prepared for the new capital gains tax changes in Canada? Let's learn how to protect your real estate portfolio from these shifts and keep more money in your pocket. In today's video, we're discussing the upcoming changes to the capital gains tax in Canada and how you can legally protect your investments and yourself, with the new inclusion rate set to rise to 66.67% for gains over 250 grand, effective June 2024. It's crucial to stay ahead of the curve. Let's explore actionable strategies you can implement right now. Liberals love taxes. There's no denying that at this point. Let's figure out a way to offset or delay or eliminate excessive taxes legally to keep more money in your pocket where it belongs. In recent months, I had an expert accountant join us, Fabio, who dove into tremendous detail on how the capital gain tax difference will work on the sale of a property before and after the change. Take a look.
So let's take a look at a numerical example of how this works. If you look on the left, what you will see is before July 25th, 2024, a corporation and an individual, okay? And then we'll take a look at after, when the new tax rates are implemented, which they are implemented right now, okay? So we're gonna assume a flat tax rate of 50% for all scenarios. So let's consider a real estate asset, right? Like a house, for example, with an adjusted cost base or a purchase price of $500,000, which the taxpayer subsequently sold for $1.5 million, okay? This is going to result in a capital gain, or a raw capital gain, of $1 million. Easy math, all right? Before the new laws were implemented, for an individual with a 50% inclusion rate, the taxable portion of the gain was $500,000. And using a tax rate of 50%, the total tax owed was $250,000. Now, for a corporation, the calculations are basically the same. It's a lot more complicated because we have something called the capital dividend account, we have RDTOH, we have a dividend that has to be paid out, and then there's over or under integration depending on the province. But in essence, plus minus a couple of percent, depending on the province you're in, you're going to end up paying $250,000 of tax if your marginal tax rate is 50%. So after the new laws are implemented, okay, for individuals, the first $250,000 of capital gains retains the 50% inclusion rate, but the remaining $750,000, did I do my math wrong? No, it's the remaining $500,000 will have an inclusion rate of 66.2/3. I think I did my, yeah. So it gives us a total taxable capital gain of $625,000, taxed at 50%, $312,000. Now, a corporation doesn't get that break on the first $250,000. It's going to get a total inclusion for the entire thing, right? So the total inclusion is going to be $666,000. So an individual is going to pay $312,500 in tax, and a corporation is going to pay $333,000 in tax if you have an active business and you have active business retained earnings. And then obviously there's estate freezes, okay? So you may want to consider an estate freeze. So this involves freezing the value of your estate or your assets at their current level, with any future growth in value attributed to your beneficiaries, your kids, okay? This strategy can help lock in your tax liability at today's rates, providing more certainty, and potentially reducing actually future tax burdens, right? But it is important to note that under traditional strategies, estate freezes for personally held properties, they can be very expensive to implement, all right? There's a lot of legal fees, a lot of accounting fees, there's appraisal fees, and you're gonna get hit in Ontario. If we do a traditional estate freeze into a corporation, you're gonna get hit with land transfer tax.
The three biggest pieces I took away from this presentation are that the tax is essentially unavoidable. You can't hide from it. What you have to do is be more clever and mitigate the tax, which is how we've been doing it in this country since taxes were invented 100 years ago. And the 3 best ways to do that are going to be with estate freezes, number 1. Number 2, using permanent life insurance to offset the tax down the road. Extremely powerful. And this is something, the third one here is something you can do on a regular basis. And that's the regular assessment of the properties in your portfolio, especially identifying underperforming properties to mitigate future tax consequences. And that means if you have properties in your portfolio that have been there 5, 10, 15, 20 years, they have a lot of equity and you're going to owe a lot of tax to it, it's better to sell it now and use strategies while you're alive and functional to mitigate the tax now than waiting until death or waiting to pass on the problem to your kids. Doing it now is going to be much more efficient from a tax perspective and save you and your children a lot of tax dollars.
But when you strip away the investment component and you take a term policy that goes to term to 100, which is a form of permanent insurance that you just keep paying until you die, they all cost the same. But universal life, I'm not a big fan of it, but I do use it when you want to know a guaranteed flat death benefit that won't grow unless you over contribute. Whole life policy death benefits always grow. But if you're at that point where you're asset rich but cash poor, sometimes life insurance is difficult to obtain because you simply can't afford it from a cash perspective. So whenever you're buying life insurance, permanent life insurance, that money is never lost. You're taking it from one pot and you're putting it into another pot. A portion of that goes to your cash account, the cash value account, and a portion gets tucked away for when you die, okay? So if you care about what's happening at your death to the people that you're leaving behind, you're losing none of that money. In fact, you're making money usually at about a rate of 5 to 7% per year is what the numbers work out to, free of tax, which based on your tax rate could be anywhere from 10 to 14% return on investment, which is pretty freaking good considering that these things you basically can't get anything more guaranteed than a life insurance policy in Canada in terms of rate of return.
Friends, you got 2 choices. You can complain and whine about more taxes or changes from the government, or you can simply do something about it. New taxes are not anything new in this country. We've had new taxes coming in and coming out for literally 100 years. So you need to have effective planning strategies to mitigate as many tax problems as possible. That's how you stay ahead of the game. The people who sit back and complain and do nothing because they might have to pay taxes are the ones that get left behind. I don't want you to get left behind. Stop making it a problem and turn this problem into a solution. In the end, effective tax planning strategies are becoming more important than ever. In fact, you're leaving yourself vulnerable if you're not planning for the eventual tax and estate planning that you have to do at some point in the future when you pass away and have to leave things to your kids. If you've learned anything from this video, is to get on the planning now. And I've given you a contact for a professional that knows what he's doing and who's willing to help you. So contact me. I'm willing to put you in touch with Fabio, or contact Fabio directly. His information is here in the description. If you found this video insightful and valuable, please like and subscribe. And remember to always seek professional advice that's tailored to your situation. We are not tax accountants and we are not lawyers. So please seek professional help. If you found this valuable, please also share it with a friend, subscribe, get the notifications. We want to help you.